Right now, let's get down to business, taking a look at Wall Street. Dow Industrial Average up 46 to finish at 12,984. The S&P 500 up 5 at 1363. NASDAQ Composite gaining 23 at 2,956. The yield on the 10-year note down 2 basis points at 1.98%. Oil up $2.41 at 108.69 per barrel. Oh my. Metals moving higher. We'll get to those in just a few moments. So oil up $2.41. How much does it cost you to get to work each week? How much do you spend on gasoline? How much do you spend each day? $10 a day? $50 a week? Maybe a couple hundred a month? Maybe more? For a lot of people, it literally is a few $100s or more every month. And when the price of gas starts to go up, it has a definite impact on their budgets and on lifestyles. Last year, the average American family spent 8.4% of their incomes on gasoline. That percentage has doubled over the last 10 years. And the price of gas doesn't just affect people who drive long miles. The price of energy gets factored into almost everything because almost everything we buy has to be transported. When the price of gas goes up, it tends to push prices up on everything. So we might expect inflation to start to rear its head. It's a possibility. The strength of the economy is largely predicated on cheap oil. When the price of oil goes higher, we tend to cut back to compensate. Right now, Americans are using less gasoline. As the price has increased recently, demand has dropped. We drive less. Still, though, the price at the pump is moving higher. So there's something a little bit more than the basic supply-demand going on here. The average price across the country now up to $3.53 a gallon. In California, the average price $3.96. Price is up 25 cents a gallon since the start of the new year. The Oil Price Information Service projecting an average price of $4.25 a gallon by the end of April. It's just a projection. Doesn't mean that's where we're going, but suddenly we're kind of bracing for this, aren't we? Part of it, of course, is the standoff between the U.S. and Iran over Iran's nuclear program. Iran has already stopped selling oil to the UK and France. China and India, though, more than happy to buy from the Iranians. Approximately 20% of all oil sold in the world passes through the Strait of Hormuz. And there have been some games being played in the Strait of Hormuz between U.S. Navy and Iranian Navy. Any disruption could result in massive shortages and scary price hikes. You may remember when oil hit $147 a barrel in the summer of 2008. And then last night at the Republican debate in Mesa, Newt Gingrich said he had a plan to bring the price of oil down to $2.50 a gallon. Unfortunately, the plan involves time travel and something called a Wayback Machine. Actually, the idea is being tossed out, mainly center around drilling, more drilling, and maybe even tapping into the strategic petroleum reserves and then more drilling. Today, President Obama said, that's not a plan, especially when we're already drilling. That's a bumper sticker. It's not a strategy to solve our energy challenge. Of course, you can go back over the past, 45 years more? And we haven't really done anything to solve our energy challenge. Oil and gas production has increased during the Obama administration, continuing the trend of the Bush presidency. The increase has reversed a decline that began in 1986. And the U.S. Energy Information Agency projects that by 2020, oil production will reach a level not seen since 1994. Today, President Obama promoted an energy agenda of oil, gas, wind, solar, nuclear, and biofuel energy. Of course, if we go back to 2008, we'll see that the response to high prices was a global financial crisis that resulted in a major recession. You might even call it a depression. And as the economy came to a grinding halt, the demand for gasoline dried up. The United States imports as much as 10 million barrels per day when the economy is humming along. And we import 8 million barrels per day when the economy slams on the brakes. Even if we drill like crazy, it isn't enough. The Bakken oil fields produce around 500,000 barrels per day, and they might be able to turn out 2 million barrels per day, maybe even a little bit more. But the Bakken oil field is not the solution. It's expensive to get oil out of shale. The cost to produce a unit of energy is much higher in the Bakken case than in traditional historical oil plays. The technology and expertise to squeeze oil out of the formation should be telling us that the days of cheap oil are over. If we're lucky, tapping into the domestic supplies will allow us to break our dependence on foreign oil, not by relying on domestic production, but using it as a bridge to sustainable, renewable energy. If we don't make that transition, we can almost certainly look forward to an economy that gets pounded by booms and busts riding on the price of a gallon of gas, or worse yet, war, to make sure that the Straits of Hormuz continue to be a conduit for oil. So what can be done to bring down short-term prices? Probably not much beyond jawboning. If the president were to announce an investigation into speculative trading in oil futures and price collusion among the major refiners, along with a new commission to consider price freezes on oil prices, that would do it. Yeah, sure. But that's not going to happen. So you got to think that it's starting to look more and more like war.